Hello friends, good morning. Myself Jagruti Lade. Today I am going to explain about the stock and derivative market. First of all, is about the stock market. The stock market in India is a vital component of a country's financial system, facilitating the buying and selling securities by providing the platform for capital formation. Some key aspects about the stock markets are the stock exchanges. The major stock exchanges in India, that is the BSE and NSE, that is the Bombay Stock Exchange and the National Stock Exchange. BSE is one of the oldest stock exchange in Asia, while the national NSE is known as an electronic trading platform. Then listed companies. Indian stock exchanges have a diverse range of the companies spanning various sectors such as an IT, finance and manufacturing and many more. Then investors. Various types of investors participating in Indian stock market, including the retailer investors, institutional investors, mutual funds, insurance companies, and pension plans. And then next is the regulatory bodies. The Security and Exchange Board of the India, that is the SEBI, is the primary regulatory authority overseeing the security market in India. SEBI formulates the regulation to ensure the fair practices, protects the investors and maintain their integrity of the market. Then clearing and settlement system. The National Security Clearing Corporations Limited, the NSCCL, and the Indian Clearing Corporations Limited, that is the ICCL, plays a crucial role in clearing, settling the trades NSE and BSE. Then stock indices. The key market indices in India include the BSE and NSE, BSE Sensex and NSE Nifty, which represent the performance of a selected stock and their respective changes. Then brokers. Broker broker facilitated for buying and selling the securities on behalf of the investors. They are registered with the SEBI as members of a stock exchange. Then depositors. Two central depository, the National Security Depository and the Central Depository Services Limited, handles the electronic dematerialization and settlement of the security. Then market makers. Market makers in India provide liquidity the market by quoting bid and ask prices. They enhance the market efficiency by facilitating smooth trading. Next is a mutual fund. Mutual fund pool money from the investors to invest the diversified portfolio stock and other securities. Asset management company manages the mutual fund. Then research analyst. Professionals and firm conduct the research and analysis the stock and market, providing the insight investors. Then investment bank. Investment banks play role on facilitating the initial public offering, that is the IPO, mergers and acquisition and other financial services. Next, functions of the stock market. First, facilitates the capital information. Stock market provides the company with a platform to capital by giving shares to the public. This capital is essential for business expansion and development. Then liquidity and price discovery. Stock markets offer the liquidity by providing a marketplace where the investors can buy and sell the securities. Then risk diversification. Investors can diversify their portfolio by investing in the variety of a stock, reducing overall risk. Stock market enable the spreading the risk across different sectors and companies. Then valuation of a security. Stock prices serve as the indicators of the company performance and future prospects. Investors use this valuation to make investment decisions. Next, market existing owners. Stock market provides an avenue for the existing stakeholders to sell their securities and exit their investment when needed. Then borrowing and lending. The borrowing companies can raise the fund through the debt instrument like a bonds and which traded in the debt market segment of the stock exchange. Investors can also lend money through the debt instrument. Next, corporate governance. The stock market encourages the transparency and good corporate governance practices. Listed companies are required to adhere the disclosure norms and corporate governance standards. Next, benefit limits of the Stock market. First is a wealth creation. Successful investment in the stock market can lead to the significant wealth creation of the investors over time. Then capital allocation. Efficient capital allocations occurs as a fund flow to companies with the promising for promising foresting, fostering economic growth. Then financial inclusion. Stock market allow the individuals to participate in the financial system, promoting the financial inclusion. Then ownership in a profitable. Investors can become a partial owners of the profitable and successful companies by holding their stocks. Then limitation. Volatility. Stock prices can be volatile, lending and fluctuation that may be unsettling for some investors. Then speculation. Speculation activity can drive price away from the fundamental value, leading to a bubble and a market distortion. Then market manipulation. Market are susceptible to the manipulates and fraudulent activities potential harming investors. Economic sensitivity. Stock markets are influenced by the economic condition and downturns can negatively impact the portfolio. Regulatory risk. Chances in a regulatory frameworks or government policy can affect stock market dynamic. Information asymmetry. Not all investors have the not all investors have access to the same information, creating information asymmetry by disadvantage some participants. The lack of portfolio diversification. Over-reliance on a stock market with a proper diversification can expose the investors to significant risk. Next is a derivative market. The derivative market in India plays a vital role for the financial system, offering the platform for the risk management and speculation. Derivatives are financial instruments whose value is derived from the underlying assets index or rate. The derivative market consists of various types of the derivative instrument, each serving different purpose. Here, key components of the derivative. Key components are future contract. Future contract represent an agreement to buy or sell the assets at a predetermined price on a future data. These contracts facilitate the hedging against the price fluctuation, offer speculative opportunities. Then option contract. Option provide the holder with the right but not the obligation to buy or sell an asset a predetermined price with a specified period. Options are used to hedging and leveraging investment strategies. Then underlying asset. The derivative market in India includes such as an equity shares, stock indices, commodities and interest rate exchanges. Derivative contracts are traded recognized stock exchanges like the NSE and BSE. These exchanges play the crucial roles in providing a transparent regulator platform for the derivative transaction. Then clearing houses. The clearing houses act as an intermediary ensuring that settlement of a derivative contracts, the guarantee of a performance of a contract and reducing counterparty risk. Then regulatory framework. The SEBI regulates the derivative markets in India. SEBI established the rule and guidelines, ensure the transparent trading practices. Then functions of a derivative markets. Risk management. Business and investors uses derivative to manage and mitigate risk associated with the price fluctuation, interest rate changes, and currency movement. Price discovery. Derivatives prices are influenced by the market expectations and serves as an indicator for the future direction of the underlying asset. Then liquidity enhanced. Derivative market contributes overall market liquidity by providing additional trading instrument. Then hedging. Participant uses derivatives for the hedging against the adverse market movement, protecting their portfolios and potential losses. Then speculation. Traders engage in a derivative market speculative performance aiming the profit from price movement. Benefits and limitations of the derivative market. Risk transfer. Derivative enables the risk transfer from one party to another, allowing the market participant to manage their exposure effectively. Then price efficiency. Derivative prices are influenced by the market expectation contribution to the efficient price and underlying assets. Then enhance market liquidity. Derivative contracts add liquidity to the financial market and promote trading. Then limitations, the complexity. Complexity can be complex instrument. Derivative can be complex instrument requiring through the understanding the underlying assets and market dynamic. Then leverage risk. While derivative offer the potential for the high returns and they involve leverage applying both gain and losses. Then market risk. Participants are exposed to the market risk and unforeseen the event can be lead to significant losses. Then regulatory risk. Chances in the regulatory policies or insufficient regulation can pose risk to participants and in the derivative market. Here are some types of derivatives. First, future market. In future market, participants enter into the standardized contract to buy or sell the underlying asset and predetermined price on a future date. Futures contracts are traded on the organization exchange by providing the liquidity and transparency. Then option market. The option market involves the trading of a finance that give the holder right or sell an underlying asset up specified within the predetermined time frame. Then forward market. With a similar future contracts, forward contracts are customized agreement between two parties buy or sell asset a future date price agreed upon today. Forward contracts are traded on the OTC rather than organization exchange. Then swipe market. Swipe market involves the exchanges cash flow or other financial instrument between two parties. The most common type of swipe includes the interest rate swipe, currency swipe, and commodity swipe. Swipe are often used by managing risk and alternating cash flow structure. Thank you.